What's up, friends? Welcome out to another Tackle Trading 101 video. Tonight we're going to talk about covered calls. Now, covered calls is a big topic, so we gotta be specific. We're going to talk about strike selection. Which call option should you sell in this strategy? We're going to talk conservative versus aggressive. I'm going to give you some best practices, some ideas for this. So we'll be breaking that all down tonight. Before I get to that, let's do the usual intro to tackletrading.com. If this is your first time joining us, we educate traders. We teach you how to invest, how to trade, and we've got all sorts of content on our website, tackletrading.com. The Pro subscription is our flagship, which gets you access to a ton of content. I'm going to put up just a bunch of stuff that you get when you join Tackle Trading. You can get a free trial, 15-day free trial, bit.ly/join Tackle Pro. We do weekly reports. We have masterminds. We have webinars just about every night teaching you a variety of different trading strategies. Tonight's webinar is going to give you a taste of the type of education and instruction you get from myself and the other coaches on a daily basis at Tackle Trading. If you want tailored education to you and you want to schedule a consultation to talk with one of our coaches, you can schedule that for free, tackletrading.com/schedule-consultation. And you get a one-on-one conversation with usually Coach Sylvia. She'll hook you up and help build an educational plan for you. So come check us out on the inside. If you like what you see tonight, we love teaching new traders. So what are we going to learn tonight? Let's pivot. I got 3 topics. Number 1, well, let's make sure we're on the same page with what a covered call is. Teach you the strategy. How do you build it? How do you structure it? Part of a covered call is selling a call option. Well, there's a lot of call options to choose from, so we're going to focus on selecting the right strike price. And we're going to focus on the delta of the call option. So we're going to compare selling 40 delta calls to selling 20 delta calls. One is conservative, one is aggressive, and I'm going to give you the pro and the con. There are trade-offs, as is often the case with trading. There's trade-offs. There's never usually right or wrong answers, sometimes, but more often than not, it is pros and cons and trade-offs. So that's what's on the docket for today. My name, I think I forgot to introduce myself. My name is Coach Tyler Craig at Tackle Trading. I'll be your host tonight. Excited to be here and appreciate you hanging out. Now, I'm going to use a couple of tools. The first thing I'm going to use is, let's go with the word document first. We're going to take some notes. I'm going to draw some pictures, but let me start with the notes here to get the lay of the land. A covered call, the structure is twofold. Number 1, you're going to buy 100 shares of stock. Preferably a stock that ends up going higher as you own it. Okay, you want to be bullish on this stock. And then 2, you're going to sell 1 call option against the stock. Buying stock is a bullish trade. Selling calls is a bearish trade. So you're coupling a bull trade and a bear trade. And by selling the call, you're reducing your risk a little bit. Okay. And there's all sorts of implications when you sell that call. First of all, you get paid. So for instance, let's say I buy a stock for $50. And then I sell, usually we sell like shorter term call options, like 1 month. Maybe I sell a 1 month 55 strike call. And what that means, when you sell a call option, I'm obligated to sell the stock at $55. So when you sell a call against your stock, you make a promise to sell the stock if it goes up to a certain price, in this case, $55. As a result, this is the disadvantage of a covered call. As a result of selling the call, you have limited profit potential. So you are willingly capping how much you can make in the stock. when you sell a call against your stock position. Now, why in the world would you do that? Why would you limit the profit you can make in the stock? Well, first of all, you're not limiting the profit forever. You're limiting it for a time. The reason why we sell 1 month call options is because every month we can resell a new one and maybe change where we're capping the stock. So if the stock's at 50 and I sell a 55 call for the next month, maybe it gets up towards 55. So the month after that, I sell a 60 call, and then it gets up to 60, and then I sell a 65 call. So you can keep raising the ceiling if necessary to adapt to changes in the stock price. Nonetheless, while you are covered, it does cap the gain in the stock. So you typically wouldn't do this if you were super duper bullish. Okay, if you're like, I think this stock's going to the moon, like pronto, like now, you're probably not going to sell a covered call. So your bias is a little bit more neutral to maybe mildly bullish. Neutral to mildly bullish. You're not going to be crazy, bullish. Okay. But again, there are advantages. So why would you limit the profit potential? You're neutral, you're mildly bullish, and you want those advantages. So what are the advantages? Well, when you sell a call, you get paid money. If I sell a 1 month 55 strike call option, I'm going to get paid. Let's say I get paid $1. Okay, now that's $1 per share. That'd be $100 for the contract. Okay, options are traded in contracts. So in this case, I'm picking up $100. That's one advantage. Okay, so advantage is plural. One advantage is you get paid premium. This is potential cash flow. If you think about it, the person who just owns the stock did not get paid $100. I got $100 over and above whatever the stock ends up doing over the next month. So if the stock goes sideways, I made $100, and I can do it again. If the stock goes sideways, I make another $100, and then another $100. So this potential for monthly cash flow is one of the incentives to sell calls. You get some cash flow. Now that cash flow is protection against a loss in the stock. If the stock goes down $100, which in this case would be the $50 stock going down to 49, because I own 100 shares. So if it drops $1 per share, I've lost $100 in the stock. But if I made $100 in the call, net, I haven't really lost anything. So you get a little bit of protection every time you sell a call. Maybe a lot of protection depending on which call you sell. So if you want downside protection to hedge or offset some of the loss in the stock, that's another reason why you might sell a call. Okay. As a result of selling the call and bringing in that premium, you reduce your cost basis, which essentially reduces your risk. So you take two traders. Trader A just buys the stock and doesn't sell a covered call. Trader B buys the stock and sells a covered call. Then the stock tanks. The one with the covered call loses less money because he's got that premium to at least offset some of the loss. So from a risk perspective, a covered call position is less risky than buying 100 shares of stock. As a result of you lowering your cost basis, that means you will have a profitable position even if the stock goes sideways, even if it maybe drops a little bit. So there are more outcomes where a covered call generates a profit than just long stock. So another way of articulating that is you have a higher probability of profit. Those are your 4 key advantages of a covered call. That's why you may willingly limit your profit potential, because you want cash flow, because you want a little bit of protection, because you want to reduce your cost basis and increase your probability of profit. Maybe those 4 advantages are worth capping the gain for a time. So that's the covered call in a nutshell. Conceptually on paper, why somebody does it, what it looks like. Now, I've kind of just told you selling 1 month calls is the general rule of thumb. Let's just take that at face value. Let's say that our MO is to sell 1 month call options as kind of the go-to. Well, that takes care of the time question, which call to sell, which expiration. Let's assume 1 month. I think that's a good rule of thumb. The second, more pressing question that we'll discuss tonight is which strike price? Which strike price? See, there's lots to choose from. You could buy a $50 stock and you could sell a 50 strike call. You could obligate yourself to sell the stock at the current price. Or you could sell a 52.50 strike call. You could sell a call a little bit above the stock price. Or you could sell a 55 strike call. You go a little further out of the money. Or you could sell a 60 strike call. I mean, there's tons of choices in terms of which call option do you sell against your stock. How do you decide? There's a few different ways you can attack this, but I want to explain what the general trade-off is. Okay, so you can sell. You basically picture a teeter-totter here, where you can either get more premium, more protection, okay, but on the other side, okay, you're getting less potential profit, lower ROI, okay. If you want higher ROI, higher potential profit, that's going to correspond with getting less premium or less protection. So these lie on opposite sides of the teeter-totter. You can't say, I want to build a cover call where I can make a ton of money in the stock and get a ton of protection. Can't do that. They're on opposite sides. Okay. So if you want a lot of protection, you're going to cap how much you can make in the stock pretty quickly. Now, if you don't need as much protection and you're trying to shoot for higher potential returns in the covered call, then you can do that. Okay. So which one is more premium, more protection, less potential upside? Well, that's going to correspond with selling at the money, or let me just say selling lower strike calls. Okay. And in delta terms, we call those higher delta. But I'll get to that in a second. So we're selling lower strike calls. If you want more potential profit and you're willing to have a little less protection, you're going to sell higher strike calls. Higher strike calls. Okay. So let me draw some pictures. We got the lay of the land here. You got the general trade-off. Let me draw some pictures and get specific on this whole 20 delta versus 40 delta. Okay. So let's take a look at, I'm going to draw a picture here. Let's suppose I buy a stock, and we will do an example. I'll do an example on Thinkorswim before we're done. We'll do some live examples. We're doing pretty good on time so far. So let's say the stock is at $50. Okay. So I'm going to buy 100 shares, right? So step one, I'm going to buy 100 shares. And then I'm going to sell a call option, right? So I could sell, there's a 52.50 call up here. 52.50 call. And let's say that has a delta of 40. Okay, that's closer to the money, meaning closer to the current stock price. And because that call is closer to the money, let's say it has $2 of premium. That's how much it's worth. Well, what if I did that? What if I sold that one? Well, you're getting $2. Let's think about the pros and cons here. You sell the 40 delta call. Okay, so let's put that here. So if I sell the 40 delta call, okay, pro, $2 of premium. That means I get $2 of protection. Okay. Another pro, my cost basis. I bought the stock for $50 and then I brought in $2. So that reduces my cost basis to 48. Okay. My break even has dropped by $2. Do it this way. Down $2. My break even has gone down $2. You're killing me, Smalls. Let's go. $2. I've reduced my cost basis or my break even. So 48 is now my new break even. I can lose up to $2 in the stock and still break even. Okay. What else? let's leave it at that. What's the con? Well, the con is I'm capped at 52.50. I can't make money above that. So if the stock rises to 52.50, that's where I'm capped. So how much money can I make? Well, I can make $2.50 in the stock from 50 to 52.50, plus the $2 of premium, 450 max gain. Okay, so I'm capping the gain at 450. Now, maybe I'm satisfied with that, maybe not, but that's the lay of the land for selling the 40 delta call. Well, what else could I do? I could sell a further out of the money call. It's going to be a lower delta. We'll say it's 20. And let's say that corresponds with the 55 call. And that one only gives me $1 of premium if I sell it. $1 of premium. Okay, so if that's the call that I sell, let's think through the numbers on a 20 delta call. 20 delta call. When it comes to pro con, it is still an advantage. Okay, it is still an advantage that I'm getting some premium, right? I'm getting $1 premium. That gives me some protection. Now, it's not as much as the 52.50, but I am getting some premium. Okay, I am still reducing my cost basis by $1. So my cost basis in this case goes from 50 to 49. Okay, I get the $1 premium. That reduces the cost basis by $1 to 49, right? What's the con? Well, again, just looking at the 20 delta in a vacuum here, the con of selling a 20 delta call versus not having a covered call is you are capping the gain. But see, the gain here, I can make $5 in the stock. I bought the stock for 50. I can make money up to 55 in the stock. So I got more upside, got more money I can make in this 55 call. Let's do the same color. Got room up to 55 on this guy. So I can make $5 in the stock, plus I get the $1 premium. So I have $6 of potential profit in this covered call. Now let's compare the two. If you sell a 40 delta covered call, more protection, less risk. Okay. But more protection, less risk, but you got to sell the stock quicker. You don't have as much profit potential. If you sell the 20 delta call, you get less protection and a little more risk, but you can make more money in the stock. So selling the 20 call, I would characterize that as more aggressive. Aggressive meaning you're more bullish. You have more upside in the stock. You're going for a bigger profit potential. If you sell the 40 delta covered call, I would characterize that as more conservative. Conservative in the sense that you can't make as much profit, but you get more protection and less risk. So which one should you sell? It depends. It depends on the situation. So what some traders will do is they'll just say, listen, in general, I like being more conservative. I like more protection, less risk, and I'm willing to make less money. I'm going to sell 40 delta calls. That's my MO. I'll do that every single month. Or say, I'm a more aggressive trader. I want more upside in the stock. I don't want to cap my gain as quickly. I'll willingly accept less protection and a little bit more risk in exchange for the potential to make more money in the stock. I'm going to always sell 20 delta calls. So, you have two different traders, maybe on the same exact stock, with just two slightly different preferences. One's always selling the 40 delta, one's always selling the 20 delta. Or you just adjust as maybe market conditions change. You say the market's pretty bullish right now. I don't want to sell a 40 delta call. If the stock goes up at all, my call's in the money and I'm capping my gain really quick. In a bull market, I'm going to sell those 20 delta further out of the money calls because I want more upside in the stock. And then if the stock breaks support and I get less bullish and we become a little more neutral or bearish in the stock, I'm going to start selling 40 delta calls because I value protection over potential profit. So listen, you may kind of shift based on market conditions. If you care what the current market looks like, if it's influencing your bias, you're more bullish, you're less bullish, then you could express that by changing the strike selection. This is one of the very cool things about covered calls is you have so many choices. You can really be as precise as you want or not. Or you may say, listen, every time I change which strike, I get more conservative and the stock rips. I get more aggressive and the stock tanks. I just want to be consistent and sell the same one every time. Well, maybe you split the difference and you just sell 30 delta calls every month, and you reason that that's an acceptable trade-off between conservative and aggressive. I know traders who do that. It's like, I'll just stick with selling 30 delta covered calls month to month. I'll call that good enough. You get to decide how tactical do you want to be? How often do you want to change the strike? And here's the deal. You don't have to stick with one for the entire month. I may have started more aggressive. Stock was in an uptrend. I sold a 20 delta covered call for April. 2 weeks later, the stock breaks support. At 20 delta calls, now a 5 delta. I'm going to go ahead and buy it back and sell a lower delta, 30 delta this time, or 40 delta to get more conservative. I started aggressive, but I shifted to conservative because the stock broke support. It demanded my attention. It demanded I change things. Or I started with a 40 delta covered call because the stock didn't look that great. Now it's breaking out. The stock's breaking resistance, and it looks quite bullish. My call's now in the money. I'm going to buy that back and sell a new 20 delta call. I'm going to put the call pretty far out of the money so I open up the upside. So you can use a break of support to get more defensive, a break of resistance to get more offensive, and you may change the strike price that you sell. Okay, last 7 minutes. Let's do an example. I'm going to do an example of each. All right. So let's take a look at Thinkorswim here. I'm not going to spend too much time on picking the stock. You guys can we'll dig into that on another particular month. But let me just take some of these commodity based stocks got whacked today. Let me do AMD. I'll do AMD. Okay, this was on our scattering report this last weekend as a interesting little uptrend here. Don't like today's candle, but let's say you like AMD as a company, and maybe it's not as much your short-term read, but your long-term, you want to get some exposure and sell covered calls. Okay. Well, you got a lot of choices. You could sell the 85 strike call. You could sell the 90 strike call. There's going to be a lot of choices on this. So if I come in here, I'm going to April. Now, I haven't bought the stock yet, so I'm going to have to buy the stock and sell a call at the same time. But look at the call strikes. You got a 41 delta. That's the 85 strike. You get $3.55 of protection with that one. You've got around a 30 delta. You're getting about $1.95 of premium. You've got about a 17 delta with about $1 of premium. So I don't really have a perfect 20 delta. So let me just compare selling the 40 delta to selling the 17 delta. I can either sell the call at 85 or sell the call at 95. Okay. 85 or 95. 95 would be the aggressive. You're picking up $1. You got a lot of upside in the stock. 85 is the conservative. You get $3.50 of protection, but you're capping the gain pretty quick. Okay. How do I know which one I want to do? Well, again, for me, part of it would be if you think the stock's going to get to 95 in the next month, don't sell the 85 call. So part of it is where do you think the stock could get by expiration? The other part is just numbers wise. What are you satisfied with? Maybe you don't even get enough money up at the 95. For instance, AMD moves about $3 a day. It moves $3 a day. Getting $1 of premium ain't that great. All it takes is a third of an ATR going down, and it's wiped out your dollar of cash flow. So I got to tell you, I'm not impressed by getting $1 of premium on AMD. by virtue of how meaningless that is. That alone would dissuade me from selling the 95. That would say, Tyler, you should do the 90 or the 85. Okay. Well, which one would I do between the 90 and the 85? It's a little trickier there. A little trickier because if I'm a little more bullish, I'm selling the 90. I want the upside to 90. Okay. If I'm a little bit less bullish, a little more neutral, want a little more protection, I'd sell the 85. The other thing that I think about is, what's the potential profit? If I can get enough profit to satisfy me with the 40 delta, I'm getting more conservative, higher probability, less risk, and I'm really satisfied with the gain. Why not? Why not take the more conservative route, right? So I often will just run the numbers and I'll say, well, what if I sell that 85, get the $3.55? Let's right click and go to buy covered stock. That's how you build a covered call order with Thinkorswim. All right, I'm buying 100 shares. I'm selling the 85 call. $77.58 is the cost basis. It's also the risk. If I hit confirm and send, it'll tell me the max profit's 742. Well, that's about a 10% return on my $7,700 cost. It's actually a 20% return on margin. Trust me, I am not dissatisfied with a 10% return on a 1 month or so covered call. I would be satisfied with that. Which means I actually like selling the 40 delta covered call on AMD. I like that it's more conservative. I like to get more protection. Yes, I cap my gain quicker, but it's still a 10% return. Okay, that would be the logic for selling the 40 delta call. And so in the case of AMD, I think that's the one that's more compelling for me. You could have a separate trader come in here, run the same numbers and be like, no, I really want the upside to 90. I am a more bullish, I have a more bullish bias, and I want a bigger profit potential if this thing takes off. Give me the 90 call. That's fine. If I started with the short 90 call, which is about a 30 delta, and this broke support, I would probably just be rolling that call down pretty quickly to play defense. So if I start more offensive, sell a 20 delta call-ish, 30 delta call, and the stock starts to break support, I can adjust and be like, all right, let's roll the call down. So part of the art of covered call trading is you getting confident and comfortable with making the different decisions, picking the different strikes, and then adjusting as needed. And the more comfortable you get with that over time, well, the better the covered call trader you're going to be. The better a covered call trader you're going to be. The final point I'll say here in closing is, I think what I like most of all with being able to sell calls against a stock is that you don't feel powerless. If you have a good investment, particularly if you're buying like the S&P or the NASDAQ or something, it's going to go up over time. The hard part is sticking with it when it goes down. And any technique that makes it easier for you to stay with stocks in the long run and embrace the higher probability, because owning stocks for a long period of time has a higher probability of profit than owning stocks for a short period of time, if you go look at the numbers. So any technique which makes it easier for you to ride through the volatility, to ride through the temporary downturns, to ride through the inevitable corrections that will come, so that you can get the long-term growth that has been generated by stocks, is a technique I'm a very big fan of. And the fact that you can click a button, sell a call against the stock, reduce the risk slightly, if that's what makes it easier for you to ride stocks for the long run, I think it's a wonderful technique. I love the idea of coupling short calls with long stock. It's a wonderful strategy. That'll do it for tonight's webinar. Plenty more on this particular topic in the Pro membership. Again, if you want to check us out, tackletrading.com. We do have a 15-day free trial. We'll be on for another edition, we'll call it addition to the Tackle Trading 101 series in a couple of weeks. If you're already a Pro member, we love you. Appreciate you being a part of the team. If you're not, again, come join us. You're going to love it. This has been Coach Tyler. We'll see you in the next webinar.